Good evening, good afternoon, good morning, everyone. Thank you for joining this webinar, How the Coming Crisis Can Make You Rich or Coming Multifamily Bloodbath. A little bit about myself, founder of Usha Investment Group and also uh, organizer and host of Multifamily AP360 podcast and also virtual conference. We focus on multifamily value add deals, Southeast market, specifically North Carolina, Raleigh, Charlotte, Greensboro markets. So that's about me. And a little bit about our guest speaker, Charles Seaman. Uh, Charles resides in Charlotte, NC, North Carolina, and serves as a managing partner for Cash Flow Charms. He is responsible for building and maintaining broker relationships and performing and overseeing the company's underwriting activities. He is also involved in with contract negotiation and capitalizing to make sure that the deals close, remaining involved after closing to manage the assets so that they perform in a manner that provides investors with exceptional returns. He is currently a general partner in 8 multifamily properties, totaling 691 units, having went full cycle on 192 multifamily property. Charles, feel free to add anything about your company and yourself, and you can take it from here.
Sure. Rahman, thanks so much for the introduction. And guys, it's a pleasure to be here tonight. And tonight's presentation is about how the coming crisis can make you rich. So for anybody who is following the news lately, which even if you're trying not to, it's probably been pretty hard to escape, there's certainly been a lot of scary headlines out there. So what we're going to talk about tonight is why now is the time to invest in multifamily. And that's something that, we feel very strongly about and something that we're actively doing. So first thing we have here is a graphic, which you may have seen leading up to the event as part of the promotional material. And what the graphic basically symbolizes is we have two separate escalators. We have one with sellers that are forced to sell, and we have others with opportunistic buyers. And you'll notice in the middle is an arrow and some verbiage in red that says transfer of wealth. So keep in mind during many recessions, that's where you see some of the greatest opportunities and some of the greatest success stories created. So multifamily is a hard asset, as many of you know, and it's something that can be seen as a sign of stability during time of crisis. So what are we going to talk about tonight? So we have a couple of things we're going to go over. The first one is who I am and who our team is. Second is what is going on in the market right now, a brief overview of that. Third is where the opportunity is, because that's really the important part. Fourth is market cycles. So we're going to talk about that because that's going to tie into where the opportunity is. For anybody who's been following real estate for any length of time, you're probably aware that we've been through some good cycles recently and cycles have shifted. So we'll talk about where things were, where things are, and where they're heading. We'll also show a case study, and then we'll talk about why now is the time to invest in multifamily. So first thing is our team. You'll see me in the upper left-hand corner. That's me with the shirt and tie on. And my partners here, we have a sizable team. So for anybody who's not familiar with us, we're Cash Flow Champs. That's the team name. And we've got a total of 17 deals that we've been involved with to date, 7 of which are a full cycle between the different partners, and 1,647 units that are currently under management. So what's going on in the market? Well, if you're following the media at all, which again, been hard not to, you've probably seen some of these headlines in the past couple of weeks. Global banking crisis, bank fail, how rising interest rates paved the way for Silicon Valley Bank's collapse. Before collapse of Silicon Valley Bank, the Fed spotted big problems. So all of these things are a sign of what's happening in the market. And we're seeing a lot of this on a regular basis. And I'm not sure about you guys, but I've seen the amount of it ramp up in the last month. So for the past couple of months, you've probably heard a lot of different opinions out there. There are some people who were saying that they think it's going to be a mild recession at best. There were others who were thinking that we're in for a period of stagflation. There's others who think that we're in for a major recession. And opinions have really been all over the place And you probably could find different data points to support any one of those positions. One of the things that I've been seeing lately is that a lot of that narrative is shifted, and now more and more people seem to be getting on the bandwagon that it's not going to be just a mild recession or just a soft landing. So let's look at a few slides of some things that are relevant to what's going on in the real estate market and in the world at this point, because we have different things that will be able to give us some insight into the future a little bit. So the first one here is interest rates. And for anybody who's been following real estate for the last year, 2 years, you're probably aware that we've seen major spikes in the cost of borrowing. And what does that mean? Well, it means that rates are a lot higher now than they were a year ago. Now, historically, what you'll see on this chart from Marcus and Millichap is that rates are still pretty low. So you'll see this dotted line, and that's indicating the average over a 65-year period, even a little bit longer than that, is 5.7%. If you go back to the late 70s, early 80s, you'll see a high here, right around 15%. And you'll notice in the last 2 decades, we've been nowhere near that. Even now, we're still fairly low to where things are. Now, keep in mind, this is the overnight rate. This is not the rate that we're seeing on the commercial real estate side, but there is some correlation. And what's happened is it's not so much the hike itself, because you'll notice that we're comparable to where we were in 2007, 2009, not really too much of a difference there, but it's the speed at which it happened. So what does that mean? It means for anybody who's had an adjustable rate mortgage, they're paying a heck of a lot more than they were a year ago, or even a few months ago. And it's shocked the system, because when most people look at deals, underwriting models aren't typically built to show that big of an increase in that short a period of time. So next thing we have is consumer sentiment. And what happened here? Well, another slide you can see is that it fell sharply during the last year, and that's driving household formation lower. So what does that mean? Well, consumer sentiment is what's going to get people to go out there and spend money. For a lot of reports, we've seen that the holiday season was a disappointment in 2022. And that was after a lot of people predicting it was going to be a very strong holiday season, because the prior 2 years had been severely impacted by the COVID-19 pandemic. So there was a lot of excitement amongst retailers. There was a lot of excitement amongst economists that this would be the first holiday period in 3 years that we really had a return to normalcy. So Black Friday and Cyber Monday were a big hit. They had record days on both. Unfortunately, the rest of the season largely fell flat. Why is that? People are afraid to spend money. There's fear because what's happening is people are realizing that jobs are being lost. They're realizing that the economy is contracting. So people are spending less, which means that you're also going to have less jobs. Because now, after the holiday season ends, you're going to start having layoffs. And what does that mean with household formations? So why are they lower? Well, as people have less money, one of the things they do is they give up independence for cost of living. So they may need to go move in with a friend or a relative, because all of a sudden they're no longer able to afford to have their own living space. So that means there's going to be opportunity. Another issue, construction. So a lot of you have probably heard that absorption is going to be an issue this year, and they're absolutely right. And that's not true straight across the board. Keep in mind, the real estate market isn't really one national or one global market, even though there is a bigger picture to it. It's a very localized business. So there are certain markets that have different conditions that aren't prevalent in other ones. So Austin, Texas, for instance, Austin, Texas has a tremendous amount of supply coming online this year. Depending on the report that you read, there's somewhere around 14% of the existing supply that's coming online in new construction this year. That's a lot of units, and that may have some problems with absorption. So what you can also see here on this slide is you see the blue bars represent the completions and the orange line represents the vacancy rate. So what's happening is in the last couple of years, you'll notice we've had a lot more completions than we have at any time prior. And these numbers have went up and up and up. Now, we've had a very legitimate housing shortage in the United States for a number of years. By most accounts, it seems that there's expected to be a shortage at least until 2035. And that may even continue longer. But in the short term, as household formations contract and new supply comes online in abundance in many markets this year, you're going to, at least in the short term, have an occupancy issue. So what does that mean? That means vacancy rates are going to rise. That means rents are probably going to drop or stay flat at the very best in a lot of cases. And because of that, you'll see opportunities, because all of a sudden people that had underwritten deals that perform at a certain level aren't able to realize that performance because there's been a change in market conditions. So another thing happening, rediscovery of price and cap rate. So that's been happening for at least the last 9 months, and it'll probably continue happening for at least the next 6 to 9 months. So keep in mind, guys, when you're looking at different assets to invest in, there are some assets that are very liquid, and that means they're easy to get into and easy to get out of. And then there's others that are very illiquid, which means that they're going to be tougher to get out of. So when you're looking at different assets, if you're looking at stocks or equities, a lot of times those are going to be as liquid as anything you'll find. But then in comparison, commercial real estate, what I say is stocks and equities are kind of like a sailboat. They're very nimble. You can get in and you can get out, and that's attractive if you want something liquid. But it's also why you'll see large amounts gained and lost in a short period of time. Whereas commercial real estate is kind of like the Titanic, where it doesn't have that nimbleness. So it's a much bigger vehicle, and because of that, it's often going to take months to exit a transaction. So even in a best case scenario, if you went out and you found the buyer for something today, it's probably going to take you 3 months to close that deal. So it's not going to be overnight. You're not going to have your money back tomorrow. And that's why price discovery takes longer with an asset class like this. So what does this slide show? What it shows us where pricing is on a per unit basis and where cap rates were. So this particular slide is showing on a nationwide level. Obviously, it will be adjusted for market by market, but what you can see is there's a spread. And you'll notice that the last couple of years, we've seen prices go up and up and up. Cap rates have went down and down and down. And now we're starting to see some decompression. Nobody really knows where that decompression is going to wind up yet, because that's what the rediscovery is. And we're finding out little by little with each day that passes. And then this one here shows the cap rate yield spread in relation to the 10-year treasury. So the 10-year treasury is the index that most agency loans are typically priced off of. And what you could see is that as the 10-year treasury is ticking up, the average cap rate is getting closer and closer to it. So you'll notice many times over the last decade, there's been a spread somewhere in the 400 to 500 basis point range, between those two metrics. The last time we can see it this tight was in 2005, 6, and 7, and that was right before the crash. So those are the boom years before the bubble burst. Perhaps we're seeing something similar here. Just keep that in mind. So what's happening right now in the real estate market? Well, in the greater economy, we see banking failures. We see a lot of fear. We see a lot of negative headlines. On the real estate side, specifically multifamily, we have a lot of operators that have leveraged floating rate bridge debt over the last couple of years, and many of them are getting squeezed, and squeezed big time. So what does that mean? Well, cap rates right now in many markets are lower than interest rates. Historically, that's not what you want to see. Cap rates did compress a lot during the last cycle. In many of the major markets in America, they were probably in the 3s, and some they probably even dipped in the 2s. And that was consistently, not on an isolated basis. Historically, that is a very low number. One of the reasons that cap rates were able to do that and that investors felt good about paying those prices is because of where interest rates were. So they were able to get bridge debt or agency debt in the mid 2s, to maybe the mid 3s. So historically, that's as good of a borrowing rate as you're ever going to see on multifamily real estate. But now that interest rates are rising, cap rates are doing the same, but they're doing it at a much slower pace. And investors generally don't want to see cap rates lower than interest rates. The second thing that's happening is rent growth is going to be limited, maybe even negative. So Yardi Matrix, which is one of the leading data services out there, is as of Q4 2022, the 31 largest markets in the US, 22 of those markets saw a negative rent growth. Okay, so just keep that in mind. The other 9 probably aren't that far behind. And then also you have interest rates are putting pressure on valuations and debt. And this is happening a lot of different ways. So one, you have just the monthly payments. So a lot of operators are struggling with monthly payments. There's 4 deals that I got into last year that have bridge debt. One of them I can think of has, when we first started that deal, the interest payment was probably $40,000 a month. Now it's $75,000 a month. That's a big difference. That hurts your cash flow a lot. When you're going in there, and even if you stress test it, what most people don't do is stress test it for as fast as this has happened, because this is certainly an extreme case. So you're feeling that pressure if you don't have the cash reserves to sustain it. What you're also seeing is a lot of operators that don't have the valuations there. So as cap rates are decompressing, what happens is valuations start to drop. So let's give a quick example. So for anybody brand new, the way you're going to calculate your purchase price is you're going to take your net operating income and you're going to divide that by your cap rate. So your cap rate is really more indicative of the market that you're in versus the individual property. And what's happening is cap rates are rising. So if somebody was to have bought a property with a $100,000 net operating income, let's say at the end of 2021, and let's say they bought it at a 3 cap, then that property would have been worth $3,333,000. Now let's say you fast forward to where we are now, and a lot of those markets that had 3 caps in front of them a year and a half ago are now at 5 caps. So let's say you use that same $100,000 NOI. Now you have a 5 cap instead of a 3. All of a sudden, your property is only worth $2 million. So in just a year and a half, you could potentially have lost 7 figures of value on that property. That's a big hit. What does that mean in terms of financing? Well, it means that if you're going to go out there and try and refinance with the higher interest rates of today and the higher cap rates, that most times those valuations aren't going to be there. So it means that some operators are going to be able to come up with cash to do what's called the cash in refinance and be able to get the refinance anyway. But there'll be a lot that aren't able to or aren't willing to. And that's going to create opportunity. And another thing is interest rate caps, which we'll talk about a little more later on in the presentation. So now we're going to talk about market cycles. The graphic on the slide is a little bit dated because it's from the first quarter of 2022, so the world has changed a bit since then. But the concept is the same. And the concept here is that there's 4 market cycles. So phase 1 is recovery, phase 2 is expansion, phase 3 is hypersupply, and phase 4 is recession. So what you'll see is there's different markets in each of these different phases. And the reason for that is, again, because the real estate market is very local. So it's very possible for one market to be in phase 2 and another market to be in phase 4. And what the line that goes across the 4 phases represents is really supply and demand. And as you start having balances and imbalances in supply and demand, that's what shifts different markets into different phases. So the first one we'll talk about here is the recovery phase. And that's a transition phase, a period of reinvention. So what's happening here is that you're seeing people get creative. You're seeing people, to kind of put in perspective as we come back to the previous slide. So phase 1's down here. This is after prices have bottomed out. This is when people are starting to get back in. Now, most people do not get in down here. A lot of people jump in around here, but you have some that are more cavalier that jump in down here. Those are the ones that have really good foresight or just a ton of intestinal fortitude, and they go on a hope and a whim. But the ones getting in there are the ones who are innovating and maybe getting a bit creative. They're also the ones that may have cash. So many of you have heard the saying, cash is king. Well, in the next couple of months, you'll probably find that to be very true because it may be tougher to get financing. So what will happen is those that have cash sitting on the sidelines will be in positions to go out there and capitalize. They'll be able to go out there and get all of these great deals that we see available because they'll be well positioned to do so. What you're also seeing during this time is a focus on fundamentals. And while that's something that you want to see at all times, it's something that, is really important at this point, because usually at this point in the cycle, you're seeing a lot of fear in both the mainstream media, in consumers, and investors, and pretty much everybody. And you're also seeing consolidation accelerate. So that means jobs are still being cut. It means that, nobody's really hiring yet. You're probably hearing a lot of negative news on the mainstream media, and a lot of things are seemingly doom and gloom at that point. So what usually happens, and what is characteristic of the real estate market at this point? Well, building pipelines. So for people, that could be building a pipeline of deals. It could be building a pipeline of investors, building whatever pipeline you need to help you achieve the results that you want to achieve. You may also reposition or rebrand. Maybe you find that something you were doing wasn't working, or it's no longer relevant, and you need to be able to go out there and prepare yourself for success in the upcoming cycle. So then the next one we have is phase 2, and that's our expansion phase. This is where new development starts. This is where a lot of things are starting to come back into the market and into the economy. And you're seeing people start to hire. You're seeing the messaging in the mainstream media change. You're seeing jobs open up. And all of a sudden, people feel that the worst is over, and now they're ready for another period of optimism and bullishness. And that's what's characteristic of this cycle. So here you're seeing new developments start. You're seeing a lot of construction starts, not necessarily construction finishing yet, but at least starting, and that starts the next cycle. You're seeing occupancy levels rise. You're seeing rents rise, and because of all these different factors, what you're also seeing is asset value rise. And you're also seeing capital become more available. So probably the biggest challenge in the real estate market is debt. There's a lot of issues that real estate investors and real estate operators work through, but oftentimes the single one that brings the market to a standstill is debt. When you don't have the ability to get financing easily, it makes it very tough to get deals done. So during this phase of the cycle, this is when you start seeing capital become available and easier to get again. So what solutions could you have here? Well, there's a few different things. You'll notice many of them are around expansion. You could expand vertically. So some people may take property management in-house. Some people may go out and enter a new niche that they weren't in. Some people may expand the geographic region they look in. Investing in infrastructure. So infrastructure could be a lot of different things. It doesn't necessarily just have to be real estate. It could be the infrastructure of your business. Maybe you're investing in your staff. Maybe you're investing in your technology. You're investing in different things that are going to help you prepare to be successful in this cycle. Then we go to phase 3, and this is the plateau phase, which is oversupply. Now, let's come back to the diagram for just a minute. So oversupply, this is the point where supply and demand start to balance out. So during the expansion phase, demand is typically greater than supply. By the end of that phase, you're starting to see supply catch up with demand, and it starts balancing out. So for those of you, I imagine you can probably see where my cursor is on the screen. So as you do that, you'll notice I'm pointing here right between 11 and 12. So you'll notice at this point, the curve starts sloping down. So usually at the very beginning of it, many people are in disbelief. They don't truly believe that the cycle's over. They still have the euphoria of all this good time that's come before it. And oftentimes it takes a while for people to realize and to accept that, okay, the cycle is over and that we need to prepare for a downturn. And that's not necessarily a bad thing, because a downturn creates opportunities. So oftentimes with many cycles, when you have years and years of bullishness, things get overbought. And for anybody who's looked at deals in the last couple of years, there's probably been a lot of truth that many deals were overbought. But as you see that downturn, the prices come back in balance, and all of a sudden that creates opportunity. So what happens here? You start to see demand and supply imbalance, optimistic underwriting. Some groups are out there putting double-digit rent increases, and Good for them if they think they can hit that, but it's certainly become a lot tougher to hit. And you're also seeing unrealistic asset values. Again, part of that might just be the euphoria from the last cycle carrying over. So TIs don't really apply here. Those are tenant improvements. That's for anybody looking at commercial, but for multifamily, not quite as important. But what solutions are available during this phase? So what you're seeing is disposal of non-core assets. So for anybody familiar with the term core and non-core, core is typically a higher quality asset in a better area. You just think of your A, your B plus, those are core assets. And why are they saying dispose or downsize of your non-core assets? Well, during these times of tough economic period, what happens is there's a flight to quality. Many of you have probably heard that term the last few months because it's something that a lot of people focus on. And what happens is during these tougher times, you have a higher probability of being able to collect rent from tenants in those higher quality assets. So that's why people shift to them. They also start accumulating cash because as they see the cycle changing, what they're realizing at some point is that it may be tough to get financing because liquidity could dry up. So having cash for that next cycle is going to be really key. And then we have the recession phase. This is our crisis phase. So in many markets right now, we're probably in phase 3 or phase 4. There are some that aren't, but many are. And the crisis phase is where rents are declining, there's little or no development, limited access to credit, asset values declining. So most markets that I see right now do have rents that are starting to plateau. A lot of markets still have development going on, but what most of them have is development that's already finishing up rather than new development starting. So what that means is once the current projects are complete, you're going to see less new construction in many of these markets. And then the big one is limited access to credit. So that's starting to happen, but let me reassure you this. If we have more and more bank failures, credit is going to be tougher and tougher to come by. The one good thing for multifamily is that Fannie Mae and Freddie Mac and HUD provide liquidity, which other asset classes don't have that advantage of, but it will definitely put a credit squeeze on the space either way. So what real estate solutions do you see during this time? Well, this is where there's opportunities. So you can go out there and acquire underperforming assets. You can acquire necessity real estate. So the necessity real estate isn't so much your core product, that's your non-core. Because you can go out there and buy these value add deals at a discount, and you can go in there and make the improvements and do very well with them. You can also just build up your market share and your branding and your base, because these are all things that are going to help you get what you need to close these deals and to be able to be successful with them. So let's look at a case study so we can see how some of this stuff works in real life. So some of you who are brand new to multifamily, you might be asking, well, what does a real deal actually look like? So we're going to talk about that in the next section. We'll go through some different examples here. So this was actually a real deal that I was involved in. I was part of the GP team in this particular one. And this was a 92-unit deal. It was a 1984 build in the Atlanta market. And the purchase price on this deal was $4,876,000. So we got a CMBS loan for this particular deal, $3,480,000. We raised equity of $2,150,000. And our capital stack, which for anybody who's brand new, that's the total of both our debt and our equity, was $5,630,000. And then we also just have some other information on the slide. These were our projections for that particular deal. So the projections that we had were based on the cash flow and the appreciation. And we were showing here where we projected the valuation for the property to be at a 6.5 cap, which seemed pretty realistic for the time this was in. And what the investor returns would look like. So we were showing here that potentially, depending on what we sold, it could be 16.6% for an average annualized return, up to 17.6%, depending on how long the deal lasted. So on this slide, we're looking at some of the different returns. So with the limited partner, this particular one was based on a $75,000 investment. And the investment was just a little bit longer than 2.5 years. We were in it for 975 days in total. So on a $75,000 investment between cash flow, profit from sale, the investor walked away with $38,000. So just shy of 51%, which was an average annual return north of 19, which exceeded the projections. So why do I mention that? Because that's the power of investing in multifamily and being involved in a good asset that's in a good location at the right time. And then what do the general partners do? So the general partnership earned an acquisition fee. That's typically paid when the deal is closed and when the raise is fully funded. And for this particular deal, it was $146,280. The asset management fee was paid over the life of the deal. So that typically gets paid either monthly or quarterly, depending on the group. So in this case here, it was $22,000. And then the profit on sale was $855,000. So the total compensation with those three items was a little bit north of $1 million. So why is now the time to invest? So as we mentioned earlier in the presentation, operators are feeling the pressure of adjustable rate debt. And this is happening all throughout the country in different areas. So this is not particular to one area, it's particular to pretty much all areas. And for just about anybody with adjustable rate debt. Notes are coming due while many are unable to refinance. So in 2020 and 2021 and 2022, but 2020 and 21 right now, there was a lot of bridge loans. And when bridge loans are issued, most times they have 2 or 3 year terms. Some of them do come with extensions, but the lenders have the right not to allow you to exercise those extensions. So that's really at their discretion. So in many cases, what has to happen is the buyers or the owners that have these properties are going to need to go out there and refinance. So let's just use a random example. Let's say that somebody bought a property and they bought a property, at maybe a lower cap rate, and maybe they bought a property at $5 million. And now let's say that property is only worth 4 or 4.5 million if they haven't done a tremendous improvement on the net operating income. That operator is going to have trouble refinancing because now the lenders are going to look at the deal and they're going to say, okay, this is the financial performance, this is the interest rate, here's where the debt coverage ratio is, and they're only going to lend you X amount of dollars. So let's say if they had a $4 million loan on that property, but now it's only worth $4 million, they may only get $3 million. And what that means is that they're either going to have to come out of pocket for the difference, or they can get foreclosed on, or they can sell at a discount. There's really only so many options, and there's going to be a lot of those this year and next year. Rising rates and liquidity crunches put downward pressure on prices. So similar to that, it's really where the opportunity is. There's a lot of operators that have used these adjustable rate bridge loans, and they're going to be in a lot of trouble in many cases. Another example is rate caps. So for anybody not familiar with a rate cap, it's different than a cap rate. I know the term sounds similar, but a rate cap gives you protection against the index. So many of the caps are based around the SOFR rate. And when you buy the cap, it gives you protection over a certain threshold. So I was speaking with a fellow multifamily operator tonight, and he was telling me on a deal he's in that they initially had a 3-year loan term or bridge loan. And when they first bought the cap, they bought it for 2 years, which you were allowed to do. And then you could always go back and buy it for the later year at a subsequent date. And for the first 2 years of that loan, the cap was $27,200. Okay. So not too bad, a little over $13,000 a year. For year 3, which for them, their year 3 is coming up pretty soon, it's going to cost $1.2 million. Okay, so let me repeat that. So it was $27,000 for years 1 and 2. Year 3 alone, to have that cap, is going to cost $1.2 million. That is a lot of money. So what does that mean? Well, it means a couple of things. It means that you could potentially have some operators who have that cash and they're going to come up with it. You could have other operators that aren't going to have the cash and they're going to be in default of their loan. You're going to have other operators that are simply going to try and sell the property and cut their loss because they realize that they're swimming in an uphill battle. That's where opportunities will be presented. The next thing is the fear in the banking system and paper assets as a whole. For me personally, I like stocks and equities, but I know a lot of real estate investors that don't. And even for people that like stocks and equities, there's definitely going to be fear out there right now. And in times like these, what happens is people look for hard assets. What better hard asset could you have than real estate that provides housing for people? It's a basic human necessity that even in the worst of times still serves a human function, so it has a value to it. Keep that in mind. Okay, so tonight we are going to offer a special for anybody who wants. For anybody who's not familiar with it, we do have a coaching program called the Aristocrats Coaching Program, and we normally do it as a 12-month program. So with our program, we have 6 coaches, which are the 6 partners of the team. We all speak about different things that we have expertise in. There's a private Facebook group, weekly calls, and weekly deal review sessions. So that way we can give people action items that help them do deals. Normally this program sells for $18,000 on a 12-month basis. But tonight, for anybody who had attended the summit and who's a guest of Rama's, we were doing a 1-month special as a trial for $9.99. Now the caveat is they would have to sign up by tonight, but if you click on that link, it'll have a promo code for the discount. And we'll open up for Q&A if anybody has.
There is one question, Charles.
Okay, good. I see one in the chat box from Chris. Chris is asking, how then does the commercial broker best position sellers looking to part ways with these assets at a potential loss? So it's a good question, Chris. I don't know if there's any way to best position it, because obviously it's not usually a positive time when somebody's going through that. But I think it's a more point of following up with them and just understanding what their situation looks like. And for most sellers who are in this position are going to be sellers that don't really want to be in that position. So they're going to be ones that are forced to sell. So if you follow up and they're in trouble, what will probably happen is eventually, you may just catch them at the time when they're ready to unload it.
Awesome. We'll give 1 more minute for a few additional questions, then we can wind it up. Feel free to ask questions under Q&A section.
Okay, well, if you have any other questions, please put them in the chat box and we'll be glad to answer them.
So, Charles, like one question from my side. So,
Yeah.
how are you looking like next 12 months to 18 months from multifamily point of view, like debt side, mainly debt side?
In terms of where it's going, I guess it's tough to figure out exactly where things are heading, but in many cases, it seems like we are heading for a credit crunch. It's tough to say which direction interest rates are going. I mean, there's a lot of speculation out there, and we'll probably have a little more clarity on it tomorrow after the Fed meeting. But it seems at this point that going down is probably unlikely. It may be possible they don't continue going up, but I think credit's still available, but it's drying up by the day is what I'm seeing, because you're seeing a lot of different lenders that are getting scared, and a lot of the banks, the credit unions are starting to be very selective with what they lend on.
Cool. Yeah. So there's one more question from Victor. There are 2 questions. Yeah. So from Victor, when you are underwriting deals, are you assuming no rent growth for a year or 2?
Good question, Victor. So for the organic escalations, I would say that's a good idea. I would assume no rent growth for year 1 and year 2. If there's a clear value add, I would say you can still include the value add bump. But what I would do is make sure that when you're doing the value add bump, it's not going to put you at the top of the market. Because being that rents are starting to come down right now in many markets, you don't want to be budgeting to be the top of the market when that top may change. So if the value add still puts you in a spot that's a good bit off the top, I would say factor that in, but don't factor in any annual escalation.
Cool. Next one, do you recommend, are you doing any bridge debt going forward?
So, I've never been a fan of adjustable rate loans, and I think I hate them now. But that being said, in the immediate sense, not really. I would say there'd have to be a really compelling reason for me to do a bridge loan again. And when I say a compelling reason, I mean, I think that would mean like buying something at 50 cents on the dollar. You know, if there's a clear reason as to why it's needed, and it's just a messy situation that can be corrected and it's at a great price, I think then it does make sense to use it. And that's really the purpose of bridge. And that's what bridge is intended to be. But as we got deeper in the cycles, what happened is many operators started using it because they weren't able to get sufficient leverage from conventional financing options. And so the answer is, would I use it? Yes, but very selectively, and it certainly wouldn't be my primary tool going forward.
Good. The next one from Sam. Would you do fixed rate bridge debt? Fixed
Sam, good
rate.
question. I would definitely do fixed rate before adjustable. But what I would say is that there's only a handful of lenders out there that actually do fixed rate bridge. So the biggest downside to fixed rate bridge at this point is that the rates are usually quite high, even higher than the adjustable rate. But the one good thing is at least you know what you're going to get. So for me personally, I'm not really big on bridge at this point. I'd rather go out there and even raise the CapEx from the equity as opposed to using bridge just to get that financed. The only way I would use bridge of any kind at this point is if there's just a really compelling reason, and that's the only compelling reason I can see is buying the deal pennies on the dollar at this point.
Awesome. There's some positive feedback about Cash Flow Champs coaching program from Gaston. Thank you, Gaston. So you want to talk anything on that, Charles?
Sure. Well, Gaston, thank you very much for the plug. I appreciate that.
Awesome.
Okay, so then we have another one here from an anonymous attendee. Do you utilize cost segregation on properties to improve cash flow? So the answer is we do utilize cost segregation on properties, but it does not improve cash flow necessarily. So the cost segregation is really for depreciation, which is going to be more of a tax benefit, but it won't have any impact on the cash flow of the property.
Next one from Victor. As most of us are looking for value-add properties, historically bridge debt was used for a high leverage, short-term to quickly turn. But if you are getting long-term debt down, what are you assuming for hold times now?
So to me, I generally always assume a 5-year hold in my underwriting. Most of the deals we do, excuse me, we usually put 3 to 7 years. And the reason we do that is because we like to have a range. But in the underwriting, we typically model for 5 years. And the reason we do that is because investors are accustomed to that. So that's what we aim for. So with bridge, if you are using that, you know, I would probably model to the end of that. So if you're doing a 3-year loan, I'd probably go with that, or you could do a refinance at that time and then potentially cash out.
Cool. So this recording will be shared to everyone. So
What's that?
this recording will be shared to everyone. So
Excellent.
and it seems no other questions at this point. Thank you very much, Charles. Thank you for sharing your point
Robert,
of
thanks
view.
for having me. And guys, thanks for attending and for listening in.
Awesome. Thank you.
Thanks, Robert.
Yeah, thank you. 1 second.